Hey guys, welcome to Dev Take Finance. In this video, we would be learning open-ended and close-ended scheme. So basically, open-ended and close-ended scheme is how we classify mutual fund schemes on the basis of investors' flexibility in that particular investment scheme. So an open-ended scheme allows investors to invest in additional units and redeem investment continuously at current NAV. The scheme is for perpetuity unless the investors decide to wind up the scheme. The unit capital of the scheme is not fixed but changes with every investment or redemption made by the investors. So, in simpler words, if we go by the meaning of term open-ended, it means that the scheme is open to its investors. So you could purchase additional units, you could redeem that scheme, you could redeem your amount from that scheme at any point of time you want. So it provides you flexibility of purchasing and redeeming the units involved in a particular scheme, which are categorized as open ended. And what you are provided, the value which you are provided, that is at the current NAV, that is net asset value, which is the prevailing market rate in that particular scheme. Now, this scheme, as I said, is for perpetuity unless the investor decide to wind up the scheme and get back the money from that particular scheme. Now, we have learnt about open-ended, it provides you flexibility, and the scheme is not fixed for a particular period of time, and changes with every investment or redemption could be made by the investors. However, when we talk about the close-ended scheme, it is for a fixed period or tenor. It offers unit to investors only during the new fund offer. The scheme is closed for transaction with investors after this. The units allotted are redeemed by the funds at prevalent NAV when the term is over and the fund ceases to exist after this. In the interim, if investors want to exist their investment, they can do so by selling the units to other investors on a stock exchange where they are mandatorily listed. So as we talked about open-ended, it was open for the investors. So when we talk about launching any particular mutual fund scheme in the market, that is called new fund offer. So new fund offer, whether it's open-ended or close-ended, that new fund offer remains for a particular period of time. So after that, if the scheme is open to the investors, that is open-ended. But after new fund offer period is over and you are not provided the flexibility to add additional units or redeem your units, so that is close-ended scheme. Because here the close-ended scheme are those mutual fund schemes which are offered to the investment for a particular period of time. So for say 15 days or 1 month, this scheme is open to its investors. So in that period of time only you can purchase the units, and you can have it. After that you won't be able to have additional units of that close-ended scheme. Now, what happens if a investor want to get out of this scheme? Now they want to redeem their amount. So after the NFO, that is new fund offer period, is over, in case of close-ended scheme, the scheme must be mandatorily listed on stock exchange. Now this is because it provides you liquidity. Now, if you want to redeem your scheme after the fixed period or tenure is over, you can do that through stock exchanges, because the close-ended schemes are listed on stock exchange. So there you can sell your units and there will be the buyers for your units. So in the same way the shares are traded, you would be able to trade your mutual fund schemes, which are the close-ended scheme. So this is how both these open-ended and close-ended scheme of mutual fund works. Thank you for watching. Do like and share my videos. Subscribe to my channel, Dev Tech Finance. Thank you all.